Good morning, everyone. Welcome back to the beginning of day 2 of the 16th Annual Milken Institute Global Conference. My name is DeVol, and I'm the Chief Research Officer at the Milken Institute, and I will serve as moderator for this panel this morning. The session is entitled U.S. Overview, First Recovery, Then Takeoff, ? I'm told that I'm just one of 2 individuals that have appeared on stage in all 16 global conferences, the other being, of course, our chairman, Mike Milken. On the other hand, my wife claims that my photo in the program has not been updated since 1998. I told her it may only seem that way, but given that we just cut through the kitchen and they didn't recognize my so-called VIP photo as having special access, it'd probably be a good idea to update that photo in the program. I know it's a lot to ask for 8 a.m. To come to a hard-charging panel this morning, especially after the full lineup of panels yesterday and the entertainment last night. Hope everyone enjoyed themselves. But we have an immense amount of expertise on this panel with me today, so I will introduce them in just a moment. We're going to explore just where the U.S. economy is at today and whether or not it is entering a self-sustaining economic recovery and whether we can ever get to a takeoff phase and when that might occur, if ever. So the fundamentals of the U.S. economy do appear to be improving. Corporate balance sheets are robust. Banks have rebuilt capital buffers. Consumers have shed debt. Jobs are at least growing modestly again. Housing prices certainly have stopped falling. Maybe they've started rising. And cheap natural gas is boosting U.S. competitiveness. Washington, D.C. certainly did its best to try and drive the economy off the fiscal cliff at the beginning of the year, but veered away at the last minute. Well, maybe the sequester is a byproduct, since both sides thought that if they put in a nuclear clause in a 2011 budget agreement, that neither side would be stupid enough to push the button. But we have discovered that there are a lot of fat fingers in Washington, D.C. So after sputtering the fourth quarter of 2012, barely growing, the economy expanded at an annual rate of 2.5% in the first quarter. But some of the most recent indicators suggest that growth slowed at the end of the first quarter. March payrolls only rose by 88,000, and we've seen weakness in other data such as manufacturing production. But how much of that slowdown is real, or is it a seasonal or other reporting issue underlying the data? So we're going to try and sort through all that and explore whether or not, how much better the economy might be if we could get a compromise out of Washington and move forward. So our panel is going to examine these issues and a few more. We're going to address longer-term issues as well, not just the near term. Look at public-private partnerships. What do we need to continue doing to invest in innovation, and what changes in our human capital policy are necessary? First, a very quick recap of how we got here. If I could have slide 1, please. The U.S. economy has had a substandard recovery from the Great Recession for a variety of reasons, and it's been brought into question whether it's sustainable. It seems like every spring for the past 3 years. We certainly have a debt-constrained recovery. Consumers and corporations have improved their balance sheets, partly through the transfer to public balance sheets, and it's limiting the pace of recovery. The job market is seeing signs of improvement, but substantially less than is required to bring down the unemployment rate in a meaningful way. And job growth fell back to 88,000 in March after averaging over 200,000 the past few months. But there are some bright spots. For example, professional and business services had job growth of 51,000 in March, and over the past 12 months, employment growth has been 533,000 in that one category. But it's still going to take over 2 more years to recover the peak pre-recession level of employment at today's growth rate. The labor force participation rate has come down to the lowest since 1979, as you see in this chart. So the unemployment rate is back down to 7.6%, but we really haven't had a robust recovery in employment. The consumer has been a pleasant surprise in recent months. Installment debt servicing burdens have fallen back to where they were in 1994. We've also seen a housing recovery, if you want to call it that, at least it's bouncing off the bottom. Housing prices do appear to have stopped falling. Hopefully they're rising again. Also, if you look at the corporate balance sheet, non-financial corporations are doing remarkably well today. Profits at their highest levels relative to sales in the post-war period. And when you look on a cash flow basis, things are even stronger. After some initial strength, exports have fallen off to about 3% growth in recent months. Much of this is due to weakness in the eurozone and the recovery there, and also a slowdown in the BRIC nations. In a recent Milken Institute report, Is the New Year Too Happy? I caution that equity markets and high-yield debt markets might be getting a bit ahead of themselves, and there might be a pullback. So in your leisure, feel free to pull that up on your iPad. The PDF is up on our website. But let's see what our panelists think, because that's who you're here to hear. I will introduce them in alphabetical order, and their full biographies are in the program. They're long and distinguished. There are still some forms of discrimination. One is alphabetical discrimination, so that's the order we're going to go in. First is Abby Cohen. She's Senior Investment Strategist and President of Global Market Institutes at Goldman Sachs. Next is Gary Loveman, who is Chairman, President, and CEO of Caesars Entertainment Corporation. All hail Caesar, with all those titles. You folks wouldn't have made it in the Roman Empire. Okay, so your response should have been, all hail Caesar. All right. Next, Raymond McGuire, a global head of corporate and investment banking at Citi. Thank you for joining us, Ray. And we also have Jim Moffatt, who is chairman and CEO of Deloitte Consulting. Very pleased to have you, Jim. And Maggie Wilderotter, chairman and CEO of Frontier Communications. Thank you, Maggie. We're going to start off with a near-term discussion on the U.S. overview in a rather unconventional way. We're going to look from the outside in. Back in my youth, when I used to forecast the U.S. macroeconomy at U.S. corporations and consulting firms, we didn't really think about what was happening outside the U.S. until the very end of the forecast process. We might look at what the foreign exchange rate was doing, how that might affect trade and capital flows. But today I would argue that you need a perspective of how external developments are affecting the economic situation in the United States at the beginning. Abby, I know you follow these developments in the rest of the world very closely, and I wanted to see if you could kick us off by telling us what you're seeing internationally and how it might affect the outlook for the U.S.
So certainly, Ross, I'm happy to start off in that way. You know, it's very interesting. If you take a look at the economic recovery, the recession ended in the summer of 2009, or if you go back a decade, the single fastest growing sector of the U.S. economy was exports. I think many people don't recognize that. We tend to focus on consumption, which of course is the single largest sector, but the real cyclical oomph has come from exports. And the other category that has also been among the most important, because it's been the second fastest growing, has been business investment, primarily in equipment and other durable goods. So when we take a look at exports, it is very important. You know, when Ross and I started in this business, exports, foreign trade, was probably about 5% of GDP. It's 3 to 4 times more important now than it was, but that only tells part of the story. The companies in the S&P 500 do an awful lot of their business outside the United States. On average, about 40% of their revenues come from outside. So we do spend a great deal of time. And as Ross indicated, there are problems. And the single biggest problem is Europe. Outside North America, which is where the United States does most of its trade, Europe is our most important trade customer. And with Europe still in recession and likely to remain so, this puts enormous pressure on U.S. companies. And so what we see is that U.S. companies have been diversifying away from Europe, which has been the primary place we've done foreign investment as corporations, and money has moved to East Asia, Latin America, and South Asia. And when we look there, we see it's a mixed picture. In many cases improving, certainly more quickly than Europe is. We think that China, which had a deceleration, is in the process of regaining some momentum. We think economic growth of 7% or more is likely, perhaps as much as 8%, which isn't bad given the size of that economy now. We also have hopes that Japan will show some reinvigoration after many disappointing years. What we're looking for here is more a change in direction than anything else. And then as we turn to Latin America, we do think that there are some good opportunities there. So the bottom line is that the global economy has gotten better, and if you exclude Europe from the mix, which is sort of a mathematical trick, but if you exclude Europe from the mix, the numbers in the rest of the world have in fact accelerated in 2013 relative to last year.
Thank you, Abby. Jim, you have a number of U.S.-based multinational corporations as clients that have a great deal of their sales in foreign countries, whether what they produce is here in the U.S. or abroad. And I know you've been doing a lot of international travel recently, the trip to Asia, I believe, and to Europe as well. What are you seeing at your firm and in your discussions with clients about developments internationally and what they might mean for the U.S.?
Ross, thank you. First of all, it's a privilege to be here, and it's also great to be in my hometown. I live here in Los Angeles, and so it's nice to get off the road. I've been in Europe twice and China once in the last month, so I spent a lot of time on the road. And the added bonus, I don't know how you did this, Ross, last night was my wife's birthday. And so as important as this conference is, it was nice to be able to take my wife out to a birthday dinner last night. So I put some real deposits in the family bank account last night. All you know what I'm talking about, right? You know, what's happened with our clients, and what you asked me what I see, first off, I'll put as an overarching piece that our clients are looking for growth externally, outside of the normal markets. But the two words that I would use to summarize the perspective of most clients today is cautious, and I'll probably underline that word, second word, optimism. And I think what those two words really mean for business today, the clients that I speak with, is first, number one, focus on growth. If you look at the earnings growth over the last several years, the majority of that has come from cost reduction or productivity improvement. So the majority of our clients today, the number one issue as we survey and talk to clients across the board is growth. We've proven that we can swing the axe. Now the question is, can we swing the bat and find growth, particularly in today's environment? Number two is to be bold. You know, this period of uncertainty that we've seen is really becoming the new abnormal. And I think it's time, and our best clients, they're getting off the sidelines. They're not waiting for the uncertainty to resolve itself. And so while they're being extremely prudent and they're looking at everything strategically and making the right decisions, they are moving forward. They're making bets. And the best clients, not only in their traditional markets or in their core businesses, they're looking to the emerging markets like Latin America, like China, but they're also looking at new and innovative products and services. So I'd say cautious optimism, focus on growth, and be bold.
Thank you, Jim. Maggie, let's bring the discussion back closer to home. Let's call it Main Street USA. Given that your firm supplies telecommunication services to small communities, the backbone, what's your perspective on how small businesses are doing and their attitudes towards hiring and capital spending? How do they see things in the near term?
So when I think about the small business sector in our markets, we're in 30,000 communities in the United States, in 27 states. We have lots of very small businesses that have under 10 employees, 300,000 of them. And they're very cautious right now. It's very hard for them to get loans in order to grow in a lot of these small communities. And it's also hard for them to continue to invest in businesses where there's still an economic overhang for the customers that they have in those communities. So we have seen cycles of purchase extend out 9 to 12 months from where it was in the heyday. And we've also seen a lot of businesses go out of business over the last several years. I would say that right now, over the first quarter, we have started to see more small business formation than we've seen over the last several years. So I think there is some level of recovery we're seeing. But it also depends on how much capital they can get to invest in those businesses. I think if you look at Main Street itself in small communities in rural America, it's still a tough time. And there's a different level set for consumers and small businesses in terms of how they think about the companies they purchase from, the companies they do business with. I thought I would just share a couple slides. If we
Please.
looked at slide 77 to just start. This slide sort of gives you a feel for the trust gap that is out there in the United States today. The feeling is the percent that agree that large corporations are generally or somewhat positive. As you can see, 75% versus individuals of 40%. If you go to the next slide, it shows that the attributes of the customer is shifting in terms of perception. In the past, they've been trusting. They give you the benefit of the doubt. Today, they're very cynical. They've been loyal in the past. Today, it's all about maximizing for themselves to make it work. And they've been dependent in the past on companies, and no longer. Today, they're resourceful. They're constantly looking around to make sure they make the right choices. On the next slide, again, we've been thinking about shareholder value. They think today about societal value, what's best for society. They've been self-driven in the past. Today, mission is important to them. They actually align with companies that they believe that mission is like them, and that's important to them. And in the past, they would do transactions. Today, they are looking for relationships in a very different way. So if we go to the next slide, just mass media used to be how you would communicate with consumers and small businesses. Today, they want it customized, they want it personalized, they want it local for who they are and where they're at. It's not about top down anymore, it's about from the bottom up. And they are very big on shared. I think we all know with social media, social networking, things are about sharing with people like them, their families, their friends, versus having it just on a personal basis. And then finally, the next slide. When I look at how we align based upon this, we are very focused on unserved and underserved areas for broadband in the United States to give them the tools and capabilities for small businesses to grow. There's a big community focus in terms of how we do business. We are very local oriented. We have general managers in 180 markets. They have full P&L responsibility, and they run those markets to be very local and to be engaged in those communities.
Thank you very much, Maggie. Gary, if I could turn to you next. You see measures of consumer confidence on a daily basis at your firm and gain insights from the boards that you sit on. One of those boards, Coach, has been performing very well recently. I know that firsthand because my wife and I exchanged Christmas presents last year, both from Coach. So I went and bought some stock. And that was actually a very good indicator. It's done very well recently. I know that you look at consumers very closely. They make decisions every day. Give us some sense of how consumers are thinking today.
Ross, I think Jim described it well. The life in the consumer discretionary sector has been tough for a substantial period of time. I'd ask you to look at slide 88 briefly. Since the recession and since the recovery that Abby described, it's been very difficult to drive fresh revenue in the consumer discretionary sector. So if you compare the behavior of consumers coming out of this recession to what they've done historically, it's been slow as these consumers have been heavily leveraged. They've been deleveraging their own circumstances. And while this morning we all got up and heard about news on consumer confidence, we don't accept confidence at the blackjack table. You actually have to have money. And money has been a little bit harder to find than confidence. And as you look at the microeconomics of the individual balance sheet over this period, it's not surprising to see that consumers from the VIP categories in our business all the way down to more retail guests have had a hard time bringing discretionary income to bear on things like visits to casinos. So we've had tremendous visitation dynamics, and you walk in our facilities, people report to me routinely how busy they are and tell me how wonderful things must be. But of course, people can't recognize that the spend of the guest in one of our facilities has come down in the casino, in the restaurants, in the spas, in the golf courses, in the retail shops, and the like. So like the companies Jim described, we have been battling and tried to be as innovative as we can to try to find revenue. Now, similarly, given the difficulty of this period with respect to revenue generation, if you take a look at slide 90 briefly, you'll see that comparing corporate reactions during this recovery to those in prior recoveries, margin improvement has been very substantial. And your chart about the rise of corporate profits reflects precisely this. Companies have been really moving their production functions in a meaningful way. It has not just been cyclical. Companies have been finding innovative ways to wring more productivity out of scarce resources, I think, than certainly ever before in our careers. And I think that's going to stick. I think these production functions are permanently superior with respect to their productivity compared to what they've been historically. Finally, if you look at our company as just one example, if you take a look at slide 92, we have found ways to deliver guest experiences at a high level with dramatically fewer people and with dramatically less supervision and managerial overhead than has been true historically. And we didn't consider ourselves to be indulgent in prior periods, but we've worked really hard to try to do this. So I think to the degree we're going to see this recovery take root and really proceed, it's going to have to turn from having been largely efficiency driven during the downturn into something where there is substantial organic growth, where consumers' balance sheets are re-enlivened, perhaps through the housing sector, and they can begin to express that with greater confidence, if you will, by incremental purchases and discretionary purchases. And we will not see the benefit of simply efficiency-driven profit gains, but something that has a greater sustenance to it.
Right. Thank you very much, Gary. Let's turn to Ray. Ray, U.S. corporations are sitting on a great deal of cash these days. They don't seem overly eager to deploy that capital. On the other hand, non-corporate activity, especially in M&A, seems to be playing a much larger role than it has in past recoveries. How do you see capital markets today and how it might be different from previous recoveries?
To the extent that we can call this a recovery, and I think each of us has already indicated that we put brackets around that, the growth that we've described here is more efficiency growth than it is the important growth at the top line, which is revenue, notwithstanding the fact that we have enormous pools of cash liquidity, notwithstanding the fact that there is the profitability as reflected in the EBITDA line. We still have a tremendous amount of uncertainty in the marketplace, uncertainty which then translates into the confidence level, both at the consumer level, which is at the Gary level, and also at the board level in terms of the activity. Where capital has now been deployed has been more in a capital market standpoint, share buybacks and dividend increases, than it has been in capital expenditures and finding ways to growth. The correlations that used to hold with respect to the capital market activity, the market-based PE, and how the economy is doing today, those correlations seem to be rather low. If I look at capital formation on the equity side, we've had 15 consecutive weeks of equity inflows, $22 billion plus in the first quarter of investment-grade debt funding, increased capital formation. Equity is up, IPOs are up, follow-ons are up. There's been a shift from the loan market to the bond market. And then there's been the increase in the shadow banking market. Right. All of this is a reflection of the capital market's attempt to manage through what remains a fairly muted macroeconomic environment.
Abby, you want to jump in? Thank you, Ray.
Yeah, I think Ray has laid out some very interesting macro observations, and one of the critical things here is to combine that with a comment that Maggie made, and that is there's an enormous divergence within the U.S. economy now between large companies and small companies. Yeah. And a good deal of it has to do with access to capital and the cost of that capital. Large companies have had good access to well-performing capital markets since 2009. Yep. There's been equity issuance, there's been tons of debt issuance at extremely low levels. But it tends to be the small and mid-sized companies that are much more dependent upon the commercial banking sector. And we know from Federal Reserve data that it was not until fairly recently that many of these banks were actually willing to lend again. They started, of course, with extraordinarily high credit standards in 2009, 2010. These have come down a little bit, and we are just now beginning to see some improvement there. And I think it's very important to recognize that we have this gap between large and small, and it also affects various regions of the U.S. In a very specific way.
Thanks, Abby. Let's spend just a few more minutes on the consumer and maybe the housing sector to some extent. We've seen an improvement in consumer spending, not stellar, but some are questioning it because the job and income growth may not be there to support it. What do the panelists think? How is the consumer doing now?
Well, what you've seen with retail sales is that they have just now reached the level they had at the peak.
Yeah.
So this has been a long cycle of recovery. I think the housing market is the single most promising thing in the American macro experience at the moment. We had the housing market leading a big part of the run-up to the 2008-9 cycle. And to the degree we can see housing prices begin to move forward, home formation, remember, children were living with their parents for extended periods of time. There was very little home formation.
And even their grandparents were
perhaps
living.
their grandparents, whoever
I
had
can
money.
attest to that myself.
We can begin to see this move in the right direction. That could be, I think, one of the most promising 2013, late 2013, 2014 dynamics to begin to move this ahead.
Yeah, I would piggyback on that. In a number of markets that were very hard hit from a housing perspective, California, Arizona, Nevada, we have started to see housing starts again, actually developments being built in communities. A lot of it has to do with there's no supply for the demand. And I think we're starting to see that shift. But there has been a new formation of households. To Gary's point, in a number of our markets, you've got 3 generations living in households today. And again, that changes the whole consumer dynamic of those households in terms of what they buy, how they interact with companies. So I think housing is a bright spot. I think we've seen sort of the bottom, and I'm hoping it starts to come up again from a pricing perspective. But we are seeing activity from a construction perspective around the country.
Now, there's been one area of the consumer market that has shown some remarkable strength, more so than I even thought, and I tend to be the eternal optimist, and that's the auto market. If you look at slide 25, for example, I think it gives you a picture of what's happened in auto sales. And we're not quite back to the previous peak, although most people would suggest that previous peak was not sustainable. But how do you describe some of the dichotomy that people are confident enough to purchase cars, but maybe not confident enough to go to Las Vegas?
Well, I don't think it's that they're confident enough to purchase cars. I think it's that their old car died.
Yeah. You're right.
I had the good fortune to be on a board at FedEx for a number of years with Pitt Hyde, who started AutoZone. And the happiest guy through this crisis that I met was Pitt Hyde, because all of us were pulling our nearly defunct automobiles into AutoZone and buying duct tape to make sure that all the pieces of the car remained within the auto-compliant standard long enough to keep them going a while. And I think what the chart shows is that there reached an exhaustion point where a lot of these aged automobiles simply had to be replaced, and there were financing arrangements available and people could get back to it. It is a bright spot, but I don't think it's indicative of an overwhelming level of exuberance on the consumer's part.
Anyone else on consumer markets, housing? Yeah, please, Abby.
I think it's important to think a little bit about the issue of the consumer's ability to spend, not just willingness to spend.
Right.
And there are some bright spots out there. First of all, we do see that incomes have been rising among those who are employed. Number 2, we do see that the debt service burden is now back down to fairly low levels. If you look at the amount of money required for debt service relative to a family's
Slide 30.
disposable income, what you basically see, it's back down to the levels of the early 1990s now. And so what we have is a situation where we have, if you will, the potential kindling for the consumer to spend more. I, for one, think that many consumers will stay fairly conservative, having been burned previously, but at least their ability to spend has improved. There is, however, one important footnote here, and it's actually more than a footnote, and that is, once again, the aggregate macro data don't tell the whole story. What we have seen of course, is a divergence in income distribution in the United States. And particularly hard hit are the category of workers that we used to refer to as blue-collar workers. These tend to be people with high school degrees, high school graduation, and not much more education. It's those jobs that are disappearing. It's those jobs that aren't paying particularly well. And so when we look at data for the nation, let's be careful not to look at the average, the mean. Let's also look at the median, and also let's look at that distribution.
You know, Abby, I would just add one thing. Back when I was a graduate student, Franco Modigliani won the Nobel Prize for something called the lifetime income hypothesis.
Right.
And it said that you spend today based on some estimate of your lifetime income and obligations. If you believe the nominal rate of return on your investments over a very long period of time will be 2%, you better save like a bandit. And you better permanently reduce the secular rate of spend that you have in the near term, because you're not going to earn enough over the long term to compensate for these increases. And I think after years and years and years of very low interest rates, people have stepped back and said, if I have $1 million in the bank, I get $10,000 interest. I'd better be careful. So I think that suggests that people are going to temper their enthusiasm for a lot of spending in the near term.
How about the mortgage market? Are banks willing to step up and extend credit for mortgages? Ray, maybe you want to take the first crack at that one.
Yeah, I think obviously it gets back to this question of confidence. Yeah. The rates at our historical lows. I think you're seeing more of the consumers come back into the market just given the attractiveness of the rates. The headlines would suggest that the consumer's back. Having said that, the requirements for down payments and therefore the liquidity that exists in these households is not what you would think it would be, or what it's necessary to be in order for there to be a recovery in the mortgage market. Obviously, we have the rates are coming back because there's more confidence in the overall mortgage market. You have to look at what's taking place with agencies supporting most of what's taking place in the mortgage market, which is Fannie and Freddie. Yep. And they remain a huge supporter of the consumer's ability to continue to participate in home ownership.
Let's turn to what I'll call business confidence. How are business leaders feeling today? Are they becoming more confident in the recovery? What's your sense from talking to other leaders? Where are they at today? Jim, please.
Yeah, Ross, I'd say kind of going back to the cautious optimism, I'd say it's mixed, and it really does depend on where you sit. Depending on what sector you're in, where your primary customer base is. If you've been serving Europe, you're not feeling too good right now. So I'd say it's mixed. But I will also say that being paralyzed by the uncertainty is not a recipe for success. And so I go back to, particularly in this environment, given the pace of change, some of the things that are happening with some of these exponential technologies. You talk about 3D printing, you talk about robotics, you talk about cyber, social, cloud. The pace of change is increasing, so for companies and for CEOs in particular, you really can't afford to wait. And it gets back to that growth dynamic we talked about. And I think this confidence is getting in the way of that. But we've recently done some research that's looked at exceptionally performing companies over 50 years. Looked at 25,000 companies, and what were the two things that really got behind that exceptional performance? And number one was all about differentiation. It's better before cheaper. You have to focus and invest in finding differentiation on something other than price, number one. And number two, revenue over cost. You can't cost or cut your way to long-term sustainable profitability. Particularly in today's environment, you have to find growth. So there's this dynamic of confidence that's getting in the way of making the investments long-term, being bold to actually succeed in today's environment. And the best companies we see are getting off the sidelines, they're making those investments, not only in their core businesses, but in some of these new innovative adjacent businesses.
And if I could maybe take that down a level to the actual blocking and tackling on a day-to-day basis for business, I totally agree that we walk this fine line of investing for the future and delivering the results that we have to deliver today. And I think a lot of big companies are very focused today on innovation for the future and investing cautiously to make sure that you keep that differentiation for products and services. But at the same time, they're still cutting costs. They're still getting more efficient. And I think over the next 12 to 24 months, you're going to continue to see downsizing. You're going to continue to see productivity focus by large corporations in the United States. And to Abby's point, big companies do have access to capital for investment purposes, but they also control the ecosystem for small business. So when there's downsizing or when there's cutbacks, it's felt and reverberated throughout the entire economy. And for public companies, we also have the quarter to quarter we have to deal with and the noise of the media. So you have all of these balances going on for businesses today, waiting for the growth, waiting for that top line growth, which hasn't really materialized for most companies.
So how difficult is it to convince a board of directors to invest plant and equipment in the U.S. today?
It's tough. I mean, the clients we deal with, they spend a lot of time. And by the way, particularly these programs that are multi-year, it's not just once. It's not the first time. You got to keep coming back and making the case over. And that there's good discipline. That's appropriate. But it's definitely harder than it was 5-6 years ago. And I agree with Maggie. I think what we're seeing is the best companies, they're still doing the cost reduction, but they're taking that cost and they're using that to free up capital to go to reinvest in growth.
Right.
So but it's tough.
Yeah. Abby?
There are two issues here that we need to be honest about. One is that large multinational companies can scour the world for good return opportunities. And we do see that many companies in various industries think that they could have a good opportunity outside the United States. And we have a second problem, and that is our tax system. Because of the way we tax multinational companies, we provide an incentive for them to keep their cash, which is very ample right now. I think you all know how robust those balance sheets are. We encourage companies, because of the tax arbitrage, to keep their money out of the United States. And so one of the things we need to be serious about is whether some form of corporate tax reform could in fact level that playing field and encourage U.S. companies to bring their cash back so they can invest it in the United States.
Abby, are you suggesting we should perhaps move to a territorial tax system?
Yeah, there are the world systems and the territorial system. Most nations are following the territorial system. The United States, China, and India are the participants in the other system, and I don't think it serves us well at this point.
Mm-hmm. Ross, let me just go back to the point you were making just before Abby's comment about convincing a board to make a capital investment. I think the fundamental issue is in the period up to the crisis, you could present your board with a story about a market that had a secular rate of growth of 3 or 4%, and you might argue that the investment would lead to a movement of share in your favor as a result. It was a very compelling case. Today, you tend to come forward with these cases in a market that may have no growth or very limited growth, and as a result, you're making an argument almost entirely on share shift, which is always going to be a more difficult hill to climb, and the anticipated returns adjusted for probabilities are going to be smaller. And hence the reason that Ray describes where you have a tremendous amount of unallocated capital sitting on balance sheets, because it's really tough to find compelling projects to apply them to. And the fallback position is share repurchases and dividend increases.
We hear a lot about this in terms of the political bickering in Washington and the uncertainty that it creates in the business community. How much of that is real? I mean, how much of an impact is that? Are companies discounting that, or is it really causing them to be more cautiously optimistic than they perhaps should be?
Well, I'll take a shot at that. I think it does cause uncertainty. It causes businesses to hold back where they could be growing a lot faster than they are today. And I think it's two things. I think it's the burdens of regulation that we have today is not kept up with where the economy is and where businesses are. So there's, in some cases, there are many industries like financial services that there are probably 6 or 7 agencies that they have to report to on a day-to-day basis. And that overhead is costly for businesses to sort of manage through that. I'm in the telecommunications business. We've been regulated since day one. So we have a black belt in dealing with Washington. But it is an overhead that I think is holding back this economy. If you look at the United States, we're a very resilient society. And I think we could be growing at 4+% if, in fact, Washington put some things in place, like a different tax code for business, or taking away some of the burdens from a regulatory perspective, or clearing up this financial situation where we're not really focused on reducing our spending as a country, too. And I think if there were some of those things that were worked through, we would see our growth take off compared to where it is today, double where it is today.
Yeah, but my sense is it gets back to something that in addition to what Maggie said, in addition and what Jim said, and that is it stifles boldness, it stifles innovation. The kind of uncertainty that CEOs are now managing through from a macro and a regulatory standpoint does have a damping effect. Having said that, it seems that the capital markets have been able to manage their way through all the uncertainty and the schizophrenia that you're seeing in Washington, with the debt markets being at lowest yields that we've seen historically, and the equity markets being at the highest returns that we've seen historically. There seems to be a lack of coordination between the dysfunctionality of what's taking place in Washington and how the capital markets are behaving.
Well, let's go ahead, Jim.
Well, I was just going to say, it's interesting. It's one of the number one things I hear talking to CEOs is uncertainty. But it's also interesting to see that, in times like this, it's the strong get stronger. And they make the investments. I know for our firm in particular, it's always tougher decisions you make in an uncertain environment, but we always gain more share in a down market than an up market. I mean, everybody grows in an up market. There is a time right now to be bold. It gets in the way of this uncertainty. That's why we keep talking about it's time to push through that uncertainty and start making some bets.
Abby?
There's one other way in which government activity has recently been a drag on economic progress in the United States, and that has to do with some of the austerity measures that have been put in place. Keep in mind that we have had job creation in the private sector since the end of 2009, but we have had significant job losses from the government sector, federal, state, and local. And of course, we know that because of the financial duress of many state and local governments who need to balance their budgets each and every year, many of the job losses there have actually been middle-income workers, including those who provide services like teaching and policing and fire control. And so one of the things we need to address is whether some of these movements towards austerity, particularly in the short term, whether they are somewhat counterproductive. And going back to your very first question, Ross, if you take a look at developments now in Europe, what you see is that a number of the countries in Western Europe are in the process of very seriously rethinking the austerity programs that they put in place because they've now been in recession for 3 years, and those budget deficits are getting larger as a percentage of GDP rather than smaller.
Let's spend just a little bit more time on financial markets. We touched on it briefly. There have been a number of regulations that we're still waiting to hear about or be finalized from recent legislation. Banks seem to be rebuilding their capital buffers, which reduces systemic risk, but what happens to banks' ability to extend credit? So, in other words, given these pending changes and the rules we're still trying to see finalized, how much is that restraining the ability of capital markets to function? So, what's the good, the bad, and the ugly, maybe, as Clint Eastwood might have said?
Well, I don't think it has a damping effect on the capital markets, just given the amount of, at least on the debt capital markets, given where rates are and given the activity that we've seen in debt capital markets, especially in the first market, in the first quarter, which is a continuation of what took place in most of 2012. Where I think you will see it is in some of the leverage markets. Right. So some of the below investment grade debt and how the regulators look at the large wholesale banks participating in supporting some of the large leverage transactions. I think you'll see it there. You'll see that from the OCC and from other regulators. That will apply not only in North America, but it will apply across the geographies. Primarily in Asia. We see it a lot in Asia. We see it less so because there's less activity in Western Europe, but we do see it beginning to take hold in Asia. The impact that it has on U.S. financial institutions' ability to be competitive with their large global non-U.S. financing institutions is a large question mark that's evolving. So Basel and the Basel regulations and the necessity to increase the capital buffers, on the one hand, that's good news. On the other hand, the adaptation of Basel in Western Europe has been much slower And if you get to Asia and ask the Chinese what Basel is, they're going to reference a city in Western Europe. So the regulation is not being applied uniformly, which will have some impact on our ability to remain competitive and be at the forefront of an area where we have historically been at the forefront, which is the financial institutions world.
Maggie?
I was just going to say maybe a combination of what we were just talking about, which is really capital investment and also the regulatory environment. I thought I would just show a couple slides on the effect of broadband and the extent of broadband in the United States and how that can change the economic outlook for a number of locations. So if you go to slide 82, I wanted to kind of give you some overviews of broadband availability and penetration and what that does for the economy. So for a $10 billion increased investment in delivering broadband throughout the United States equates to about 180,000 jobs a year. So it's a big job growth opportunity. 10% broadband penetration equates to 2 to 3% employment improvement throughout the country. Productivity also goes up by 1.3% from an output perspective based upon broadband penetration, and it also improves GDP. And if you think about it, these numbers are substantially higher in low population density areas in the United States. So if you go to the next slide, slide 83, we've also seen, though, that adoption lags availability. So in the United States, on average, it's about 90% availability for broadband. In rural areas, it's more like 75 to 80%. But we've also seen the fact that you have to educate the market who has not had broadband to the benefits of broadband to start that cycle. Our company has invested over $1 billion in our network since 2009. We're now at about an 85% penetration throughout our markets. In that 2 years, we took it from 60%. So we're now starting to see some big growth opportunities. So if you go to the next slide, I thought I would just give you an example of what's happened in Pennsylvania. So we have 3 very small markets, small meaning 25,000 people or less in those markets, that are in the fracking area of Pennsylvania, where there has been less regulatory oversight for both broadband and also for this new form of energy for the country. But these are the dollars associated and the taxes and the employment in that area of Pennsylvania since fracking came in. We put in broadband and also to support the efforts that are going on there. So the value added is regional GDP. That's where the increase in regional GDP has come from. You can see in 2011, which is not on this chart, state and local taxes, $1.2 billion increase in state and local taxes. And 156,700 new jobs were created during that period of time. You can see the forecasts, they're very robust. The jobs have been growing in hospitality. So Gary, there's an opportunity for you. Health, education, and real estate. Those are the 4 primary areas that we've seen job growth. And then just the last slide that I'll pull up is slide 85, kind of gives you a sense that the residential broadband growth, northern and southern Pennsylvania, so we have markets in both areas. The northern area is where the energy fracking is going on. You can see customer growth at almost 80% in those areas versus 20% in the southern part. And the broadband sales in these areas actually lead sales in most of our markets in the United States. We've also built broadband to cover 100% of those markets. So what happens too is you get this incremental effect that as you see the economy start to improve, we've allocated more capital to those markets too for those returns.
Thanks, Maggie. Let's spend just a moment on what I might call tax spending deficit. We have some panels that specifically address this, but I know in the discussion we had previously, there seems to be some deficit debt fatigue setting in on the part of corporate leaders because they don't feel that there's a serious response being taken place. So my question would really be, what do you think is at least an acceptable outcome in terms of potential compromises to reduce the deficit that could be realistic, and maybe it removes some of that uncertainty that business leaders feel today? Gary, I know you've been working in this area.
Yeah, I've been working on this quite a bit, and I think it's a surprisingly easy answer to what seems like such a vexing problem in the debate. The answer is straightforward entitlement reform phased in over a relevant period of time and no further austerity in the near term for the reasons Abby described. So the economy remains very weak, employment is far below where it needs to be, capacity utilization is low. This is not a great time for a menu of austerity. At the same time, we know that entitlement issues are the drivers of long-term deficit and debt accumulation, so they have to be addressed in a meaningful, credible fashion, and there's absolutely no harm in doing so. Telling people that are today 50 years of age that they'll hit Medicare and Social Security eligibility a little bit later than they would have otherwise, and that their cost of living adjustments will be modestly lower than they might otherwise have anticipated, and higher income beneficiaries will receive a little less than they might otherwise have received. None of these are earth-shattering sorts of realizations, but they would reduce the secular development of these entitlement burdens dramatically and put the country's deficit and debt on a path that we could live with, and at the same time allow the economy to continue to heal. I think that's got to be the right recipe. Unfortunately, entitlement reform is, it just seems to be such a delicate issue that even simple things die on the vine.
Does anyone have any cautious optimism that there might be some type of compromise that could be reached, and maybe something that Republicans wouldn't call a tax increase, that might be a revenue enhancement that could maybe be factored in, and we maybe get some entitlement reform, at least around the edges?
Well, so far the president has come out and said he's prepared to adjust the cost of living index for Social Security recipients, which is a modest but important step in the right direction. The bigger benefits come from raising eligibility ages, which is a sensitive topic, and other modifications to the inclusion of Social Security participation and a few other things. And I think the president's really going to need to step up and lead on some of these issues, and then congressional leaders are going to have to do the same.
Anyone else on the topic? All right, let's move on.
I think if we were in Vegas, we could play the odds at Gary's casino.
I mean,
Well, Gary offered to cut us a deal to come to Vegas next year for this panel, and he said he'd have slot machines in the back so we could go use them at the end. Let's move to some more longer-term issues. Cybersecurity. I mean, it's not typically a topic that you might think about that comes up in a kind of U.S. macro overview discussion, but it seems to be much more important today. Both, perhaps state-sponsored sources of some cyber attacks. No definitive answer on that. Maggie, I know you've been addressing this issue as really the chair of the President's National Security Telecommunications Advisory Committee. Just how big a threat is this to U.S. businesses today?
Well, I think it's a huge threat. If you want to pull up slide 86, I'll go through this fairly quickly. But if you think about cybersecurity, it sort of takes two forms. It's stealing and it's spying. And we have this combination going on where the spying is more from a nation-state perspective. China is a good example of that we've had some big challenges from a business perspective for IP and intellectual property and actually trade secrets. We've also had the challenge in Eastern Europe about these rings that basically are there to steal. And it's identity theft, credit card, personal information, and hacking. So attackers, we've seen, at least on the networks, the infrastructure in the United States, is attackers go in and they sort of quietly get into your network. And a lot of times you don't even know they're there for a fairly long period of time from a detection perspective. Large companies like financial services that is on the front lines of this, defense, a lot of the aerospace companies have very, very good systems in protecting their data, both outside in and inside out. A lot of times we think about, let's put the firewalls up and keep stuff from coming in. But with the devices that we all use today that go with us, you bring those devices back onto networks and you bring back problems with you. And so it comes from the outside in, just like the inside out. In addition to that, you've got threats from web applications. You've got individuals that don't protect themselves. We use our same passwords over and over again. It's usually your mother's maiden name or your dog. And a lot of the attacks are coming in with valid ID information. So if you put stuff out on social networks, these attackers will go comb your Facebook site, your LinkedIn, and they'll figure out what your passwords are. So part of what we're trying to do is to protect the infrastructure in the United States from those attacks, and to be able to have business and government work together in a public-private partnership to share information. because it's a war. It's a different way of doing terrorism against our big companies and small companies in the United States. We also think that middle and small businesses don't have the capabilities or the finances to really put up the right kind of resistance to these attacks like bigger companies do. So we're also looking at solutions for that as well.
Abby, anything else to add on cybersecurity?
I think Maggie has covered very well some of the important issues at the corporate level. I would add, never take a memory stick when you go to a conference. Yeah. Don't use them because they create problems. By the way, at Goldman Sachs, where we are very careful about this, we have incredible restrictions in terms of the equipment we can and cannot use, and memory sticks are something that simply will not work in any of our systems. From a macro perspective, this is also a hugely important issue. One of the things I think that struck many economists as a good development, a surprisingly positive development as a consequence of the financial crisis, is how little direct trade protectionism there was. Normally, when there is that sort of economic duress, companies throw up all kinds of trade barriers. And what we are seeing now, however, is that there are important talks in terms of the Trans-Pacific Pact and also now a Transatlantic Pact. And at the top of the list of trade issues is cyber. Because there is so much concern about it. A good deal of it, of course, as Maggie laid out, has to do with governmental worries, but also the misappropriation of intellectual property. And for companies in the United States, this is critical. You know, our business model as a nation is not to be the low-cost producer. Our business model is to be the high value-added, high-quality producer, and IP is essential to that. And I think it's one of the reasons, it's just one example, why U.S. companies have in fact been far more reluctant than companies from other nations to do a lot of FDI in China. We don't typically in most of our industries bring the highest quality processes and technologies to China. We keep the lower quality, lower IP stuff there.
Ross, I think the way to think of this is a permanent tax. Right. All of us are going to have to defend ourselves against this. This will never go away. It's very expensive, and it generates no incremental value other than the avoidance of catastrophe. So you can think about the burden on the company having all sorts of typical expenses associated with it. Now there's a new one, and it's going to continue. I have to say, just for a temporary giggle that I discovered, you run a casino company, a lot of weird things happen. I discovered a year ago that our convention and salespeople, in a very well-meaning way, had just sold 80,000 square feet of convention space to the Black Hats Association, which is the group of cybersecurity bad guys. They actually have a convention. They gather, and it turned out we had sold them the opportunity to gather in our hotel.
Are they big spenders or not? Are they big spenders?
So this was as if you had given your convention space to the Bank Robbers Association of North America. So we got to gear ourselves all up to make sure that we were not only hosting, but also in broader sense, hosting the cybersecurity people.
Yeah, I think the other thing to keep in mind is the hackers are getting more and more sophisticated. And they get better all the time. And one of the things that we're prevented from doing in the United States is sort of sharing information across businesses that are in the same industries in order to fight these attacks, because it's antitrust in the way the law is put out there today. And we are trying to get changes to that law. I think the administration and the president are very open to that. I think Congress is as well. But that is one area that if government and business to business could do more sharing and could be more of help when someone gets into trouble, we're going to have to collectively fight this war. We can't do it as individual companies. It's not going to work.
Just add one thing. I think Maggie's right. I mean, this is, well, actually two things. I'm going to go home and change my passwords, actually, number one. But two, this is not, we're not equipped to handle this. This is the pace of change around this is accelerating faster than corporations are ready to handle it, and you can't do it alone. It is going to take a partnership across the private sector, but also with government to get this solved.
And you have to think about your supply chain, and that comes from all over the world.
You know, that's an interesting point. We did some interesting work for the security agency that was looking at supply chain, and so you have protected products at the end that are protected, but when they actually went back and looked at the supply chain and actually looked at the number of suppliers and got underneath that, they found some very, very disturbing elements. and what were very secure programs. So it's not just cyber, it's actually the supply chain as well.
Yep.
We touched on this very briefly, but I just want to spend another minute or two on it. Corporate taxes. What would be an acceptable outcome in terms of any type of budget compromise, tax reform, in terms of adjusting corporate taxes? Where would you like to see it go that would make a difference, maybe is the way to put it? Please, Abby.
I think what we need to do first and foremost is to clean up the system. While much has been written about the fact that the United States now has the highest statutory corporate tax rate, we don't have the highest effective tax rate because of all of the various exclusions and credits and so on. And it's more of a Rube Goldberg machine, for those of you who remember what that is. Basically, all kinds of things kludged together. It's great for tax attorneys. It's great for people who know how to go through the tax codes and so on. But I think the complications in our tax system make it very difficult, especially for small and mid-sized businesses. So I think that the goal of corporate tax reform, which, by the way, seems to have bipartisan support, the goal should be to make sure that it's simpler to use. There's a whole theoretical argument about who really pays those corporate taxes, whether corporations merely pass them on to others. I'm not going to get into that discussion, but rather talk about the fact it would be much simpler for businesses if the corporate tax system was cleaner than it is right now.
Gary, my guess is there are some interesting discussions that take place on the subject at the Business Roundtable. A lot of disparate views on this. Has there been some type of agreement amongst the leadership?
Well, I think the Business Roundtable is completely focused on what Abby argued in her first comment on this, which is that you need to move to a territorial system with lower rates. And of course, to get that done, the president's going to require that a series of deductions be taken off the table here, and many of us are attached to, my company, for example, is very substantially attached to the interest deduction, and other companies, oil companies, have their own set of deductions. Everybody has their favorites. So conceptually, there's a high degree of enthusiasm for a simplified system, but there's going to be a lot of these individual cases that have to be addressed. The Business Roundtable, however, is completely in support of the territorial scheme and a simplification generally.
Yeah, I think you have to broaden the base, you have to reduce the rate, and you have to get rid of the exclusions. And it's really a three-prong approach. I also don't think Washington has an appetite to just do corporate taxes. I think they would only do it with personal income tax reform, so it would be a comprehensive tax reform, which we all know is very hard to get anything done that's comprehensive. So there's been a lot of back and forth. I think the Simpson-Bowles proposal that was put out there a couple of years ago is a great foundation for getting to where we need to get to. But I think that it's going to have to be pretty transformational for it to get passed.
Let's touch just a moment on energy. Maggie, you brought it up earlier. If we could have slide 18, please. Just how large of a dividend might the U.S. see from these advances in drilling technology that we've seen in the past few years, horizontal drilling, so-called fracking technology? U.S. domestic oil production is the highest it's been in 2 decades. And you can see what's happened to natural gas production here. Maggie, I know you've done a lot in this area, but how big of a potential upside is there stemming from this?
Well, I think that the United States has the opportunity to be independent of foreign oil and foreign energy over the next 5 to 7 years. If we continue to see the changes that have been taking place over the last couple of years, that is truly possible. There does need to be more openness, though. I think in North America, you need to be able to work with Canada and Mexico, who have huge resources for energy reserves, just like we do. I think you have to be able to drill in addition to natural gas. And I think putting those pieces together and getting independent puts us in a very different situation from a foreign policy perspective, and also puts us in a different situation from an export perspective. So this is a good news story in the economy today, and I think it will continue to be.
Yes, Abby, please.
I'd like to use this good news story to introduce a bad news story. Okay. One of the reasons fracking has been such a success in the United States, and I agree that there are all of these benefits that will accrue to us, is because U.S. industry has invested heavily. Many people are not aware of it, but our production of liquid and energy resources is roughly the same as Saudi Arabia and Russia. We're the three big producers in the world. And if you look at the amount of R&D done by the United States relative to the others, just in this category, it's absolutely phenomenal. Yes. The United States invests 14 times more than Russia. And again, we all have the same amount of stuff that we produce. And we invest 25 times more than Saudi Arabia. So maybe it shouldn't be such a surprise that the United States has had this success. That's the good news. Now I'd like you to look at slide 60, because here's the bad news version of R&D spending. We've done a great job in some industries, but overall, we have begun to lose our edge. What you're looking at here is R&D scaled by GDP. The United States still does more R&D than any other country and more basic research. We're the world's single largest economy, still by a very wide margin. But when you scale it by the size of our economy, we have gone from a couple of decades ago dramatically above everybody else to now we're sort of in the middle of the pack. And relative to ourselves, we have declined dramatically as well. And so my concern is that the sort of long-term investment that the United States was always so good at, that gave us the economic edge, investment in R&D, investment in basic research, and investment in education, these are the real deficits. There was discussion yesterday here at the conference about the way the level of educational attainment for our young people has not improved in years. We've gone from number 1 in the world to number 12. This is not acceptable. In terms of basic research, we have not increased along the lines of the growth in our GDP. And I have to say, I get somewhat vexed when people say we can't afford it. We can't afford not to do these long-term investments. And I'm going to give you one historical anecdote. 1865, not a great year for the United States, right? We're in the Civil War. And the US government in 1865 made 2 significant long-term investments. One was to begin work on the Transcontinental Railroad, which opened the middle of the United States, connecting the East and West Coast. It was the broadband of the day. It was essential for the economic development for the next century in the United States. And the other big investment undertaken during the Civil War, when we had an awful lot of financial duress and other strains as well, is the Morrill Land Grant Act, in which we created state colleges and universities to promote science and to enhance the productivity of our industries at that time, including agriculture. And when we take a look at our spending as a nation on education, now we have fallen behind, not just at the state and local level for K through 12, but also at the university level. And so my plea is that we focus really on these long-term investments.
Right. Real quickly, and then we got to get to conclusion. Anything else on education related? All right, here, let's wrap it up this way. We've heard a lot about what could go wrong, and there's been some cautious optimism here. What would you think is the top thing that could go right in the U.S.? What do you think is the upside risk? What might it be? Please.
I think Abby hit it on the head. I think it's investing long and it's R&D. I mean, it's no secret the companies that emerged the fastest from the downturn were the companies that maintained their investment in R&D. There's nothing preventing us today from innovation other than ourselves. The technology, the rate of change, the new technologies emerging. Look what happens when I visit our clients in Silicon Valley. The best clients there, they're investing 35% of their budgets on R&D. They're taking advantage of what's out there, taking advantage of the technology. Think about the transformation that 3D printing will have on manufacturing in the United States. Think about robotics. Think about crowdsourcing. All these new innovations that are out there today. But you have to be willing to be bold and you have to be willing to invest long. The seduction of the core businesses, particularly companies that are successful, is to think differently. A couple years ago, we finally set up a different group a little bit distinct, just to focus on innovation, new adjacent businesses. It's hard for somebody that's grown up being successful doing the same thing to think differently. The opportunities are there, but you have to take advantage of it.
Ray, what do you think?
Listen, I think we are, the good is the energy independence. It is the health of the U.S. corporations. The not so good is the confidence, the persistent lack of confidence. What's on the horizon here that can change the equation is confidence in Washington. Leadership in Washington, bipartisanship to address some of the issues that are obvious to us. That can change the entire equation, given what's taking place in the energy independence.
Thank you, Ray. Gary?
If I could hope for something, it would be comprehensive immigration reform to drive an increase in the number of skilled folks coming into this country who will buy houses and buy consumer products and begin to move the country ahead. And I think we'll see that manifest in the ongoing improvement of the housing sector. So if we could have two things go hand in hand, comprehensive immigration reform and the ongoing recovery of the housing sector.
Abby?
I think that the most important thing is to make sure that the measured rise in confidence on the part of consumers keeps up, and that we see a corresponding increase in business confidence, because the one thing that has been sorely lacking in this economic recovery hasn't been profits. It really has been job creation, and it's when you begin to create more and more jobs that you get that dynamic in which the economy continues to grow and it becomes self-feeding in a very positive way.
Maggie, you get the last word.
Okay, so I think the good news story is we have a resilience in this country that's a secret sauce in terms of constantly reinventing, constantly innovating. I think energy, I think infrastructure are huge opportunities in this country to continue to drive that innovation. And I'm going to remain cautiously optimistic.
Good. Well, please join me in thanking our outstanding group of panelists, and we appreciate your attendance. Thank you.
Abby, that was fun.